it does extend to, in some limited way, to trusts and companies. And the trusts and companies where it's limited, as I mentioned, we've got to look at each client's individual circumstances to work out what and how it actually applies. But it could be that those entities don't actually have officially any employees on the books getting wages through like the payroll system. And there's potentially an opportunity that at least one either beneficiary in a trust or a director in a company could then make the entity eligible for the JobKeeper payment for that one individual.
Yeah, and that's probably one of the issues that we're sort of flagging at the moment is particularly in relation to partnerships, where only one of the partners in the partnership can get the payment.
That's a bit tricky too, because if you have your mum and dad partnership, then that JobKeeper payment is basically flowing into the same family, but you legitimately have some partnerships that would be two unrelated parties that are equally in partnership, and the requirement at the moment is that one partner needs to be nominated, even with their name and tax file number and so forth. So to see how that actually rolls out about how it goes through the tax system into their return or anything like that is sort of yet to be seen. But I guess there's some information. Does the payment go to the actual partnership itself or to the individual partner? Not quite sure yet.
Yeah, and that's some of the detail that certainly will be released in the next couple of days. There's also been some talk about those businesses where wages aren't being drawn, where the I guess that the wage, for want of a better word, is being paid via a trust distribution or through dividend payments. So technically not paying a wage, but obviously the owners of those businesses are still getting paid, but via a dividend or a trust distribution.
Yeah, they did clarify that it needs to be for in lieu of labour. So effectively being paid dividends in lieu of in salary or wages and for labour, and the same thing for a potentially working trustee. So it's broadened it a little bit, and even directors who receive directors' fees for being a director of a company. But again, that's for linked to labour. Need clarification a bit more on what if it's a non-trading entity and more has investment and so forth. There's been some little bit more information about that too, with the types of turnover that's actually allowed to make the entity eligible. There's a turnover criteria, and they have given some clarification that it is Australian sales only, excluding overseas sales. Turnover will be in line with the GST legislation and what you put on your BAS, and also that it excludes input tax supplies. So entities that have, say, residential rent or just interest income and a few other things might find that unless they have actual trading income, they might not, and the trading income itself has actually reduced, they may not be eligible.
Yeah, and I think the thing to take away is that the ATO are closely aligning this with the BAS periods and BASs, and that's because they have a data set in relation to each business in regards to turnover and the like. So the concept there is to try and make sure we're comparing apples and apples. So from a turnover point of view, as Angela pointed out, it'll be based around what goes on your BAS. One of the things that we don't have clarification at the moment is whether or not that's aligned with your whether you account for your GST on a cash or an accruals basis. So what, a large number of our clients, the numbers that they put on their BAS is in respect to when they actually are collecting their money from their customers, as opposed to when they're doing their invoices. From a tax and accounting point of view, turnover is calculated based on the accruals method or when you're issuing invoices. So there's a little bit of work to be done there just to clarify that. The other thing that is a common question from clients is, what if my income for March has stayed, it has been a normal month, but I'm anticipating a reduction for April, May and June. Can you provide any insight there as to what the view is in?
Yes, definitely. So they're allowing businesses to make the decision if they've actually had an actual reduction in turnover back from the 1st of March. So people who know that they've actually closed their doors and have been significantly impacted quite clearly could probably see through their March numbers that they definitely meet the criteria. But the actual system doesn't actually start until the 30th of March, which is actually the end of that period. So they're allowing employers to self-assess. And when you register, you are basically giving a declaration that you either have or that you are anticipating a reduction. So you ideally would be wanting to make sure that you actually do genuinely believe that you're going to have a reduction so that you don't actually accidentally get overpaid and have to repay money. But the issue then is that you could then use your reporting from April or any other particular period within this 6-month period that you then do start seeing a reduction. So it's not restricted to people who've been impacted yet to the end of March, but it can be what they've been impacted by since the 31st of March as well.
I think, and also just to add to that, you can enter the system at a later date. So if your turnover's not, you don't see a reduction in turnover until say June or July, you can register at that point in time.
Yeah, interestingly there though, that the unfortunately they're not going to back pay your payments. So when you become eligible, then that's when they will start the payments, but it won't be retrospective back to the 30th of March.
Yeah, and likewise, you can elect to leave the system at any point in time. So at the moment, it's designed to go for 6 months. There is a finite period at the end, and you can enter and leave that period, the program, I guess, as you see fit. There's still the legislation that was enacted last night actually didn't talk at all to how this 30% reduction of income was to be calculated. That was probably one of the things that we were expecting it to do. It didn't actually talk about it all. The legislation last night was all about amendments to the current laws, and with particular respect the Fair Work Act, and we'll get to that in a second. So the ATO has actually really got the discretion to determine who is eligible and who isn't. And as I said, they will be able to do it on a case-by-case basis. If you can't show that your turnover reduced by 30%, but you still believe that you're entitled to because your business has suffered a downturn, then you can certainly talk to the ATO about alternate ways of calculating how your business has been impacted and get approval that way. Now, we don't know exactly what the process to do that is yet, but we do know it's available. And probably the one thing that I would say there is that they are genuinely trying to get this money to the people that need it and the businesses that need it. And, you know, a couple of other questions that we've sort of been fielding during the week is, you know, what about if I'm a building and construction company and my income is really lumpy? You know, it's not uncommon for those businesses not to earn any income in a particular month and earn a whole lot in subsequent months. So again, that's where we would be looking to the ATO to just apply their discretion there. And it's a matter of putting a case forward to them to say, well, we think we qualify because of X, Y, and Z. And getting an outcome there. So just, you know, the JobKeeper part of it is really the first piece in the puzzle, if you like, that flows onto all these other concessions, and it's whether or not you qualify. So if we determine that a business does qualify, what we want to do now is just spend a little bit of time talking about what the options are for those businesses that do qualify for JobKeeper and what they can do in respect to their employees. So broadly speaking, it offers businesses $1,500 a fortnight for each eligible employee. And that's whether they're working or not. But there's been a whole lot of detail filled in during the week about how that works from a practical point of view. So we might just start, Angela, about how that applies in relation to businesses that are continuing to trade and pay their employees?
Sure. I shall go back one step. If they actually have stood down employees and maybe aren't trading, there's probably three sort of examples. The first is the business has actually ceased to trade and has stood down employees. Those employees can be rehired. So effectively, they become still engaged with the employer. The employer will pay those people a minimum of the $1,500 a fortnight gross in income. Normal pay-as-you-go withholding applies to that. But in those instances, the employer doesn't pay superannuation on that, and the employee essentially has a guaranteed income for the period that the business remains closed or they remain stood down up until the maximum of the 27th of September. The second category is businesses who may have had a reduction in turnover, which means they may have had their employees to reduce their hours. If that's the case, and an employee may still be over the $1,500 a fortnight, but they may, with reduced hours, be then less than that. So, for example, if they were down to $1,000 a fortnight gross from normal working hours, then the employer will receive the $1,500 and pay the full $1,500 to the employee. But the first 1,000 would be normal wages, and then the job pay will be the top up to the $1,500 amount. I'll come back to something just about that's only just come out in legislation overnight too that is relevant there. The other scenario is for people who may have still a reduction in turnover, but not enough to have their employees' hours reduced where they're they could be working normal hours or at least getting more than the $1,500. Those employees will be paid exactly the same. So whatever hours you work, you must be paid for at the same rate that you're currently being paid. And the employer will simply get the $1,500 as a wage subsidy to help out with the cash flow regarding those payments. But the employee really doesn't have anything different happen to their pay packet. What has come out overnight has been clarified in regards to if an employee is working hours, so either no hours, so being stood down, alternatively reduced hours, and their actual working hours are less than the $1,500 a fortnight, then employers now can direct an employee to take annual leave to take them up to the $1,500 a fortnight equivalent total pay, but the employee must retain a balance of 2 weeks annual leave. They can't be forced to take annual leave or be asked to take the direction of taking annual leave if it's going to mean that their annual leave balance goes down below a balance of 2 weeks. So in some respects, then the employer gets to reduce their annual leave balances on their balance sheet, at the same time get the government stimulus to support that in cash flow. So that's really for the stood down employees or the people being paid generally for working hours less than the $1,500 a fortnight. For the people earning more than that, really nothing changes. One other interesting thing too to make sure you note is that annual leave and other leaves, so annual leave, personal leave, does still accrue at an employee's normal hours, not at their reduced hours. So if they're a normal full-time employee and they've been reduced hours down to say 10 hours a week, well, they're still going to accrue leave at the full 38 hours equivalent.
Yep.
So that's actually an interesting thing, just to make sure people's software systems and payroll systems are going to be set up where they could actually be accruing a larger amount of leave than what currently maybe their payroll items are set up for some other reduced amount.
Yeah. So in respect of businesses registering for JobKeeper, should they do that straight away? Or do they need to do it before their next payroll, or do they just need to do it before the 30th of April?
So if you genuinely believe you either have or are anticipating a reduction in your turnover by more than 30%, and that's for those businesses less than $1 billion, and there's a different threshold for those larger businesses. But most of us will be looking at that 30% reduction threshold. You should register your interest on the ATO's website. You literally put ATO and put JobKeeper payment. It takes you to a registration box. You just put your name, ABN, business name, mobile and email, and it's just registering your interest at the moment. It's not actually open for registration just yet, and I don't imagine it won't be too far away now that legislation's passed overnight. But you initially register your interest. You then will be required to provide information to the ATO on all your eligible employees. Initially, the ATO will use your single touch payroll data from your payroll software. For those clients or those taxpayers that are not currently on single touch payroll for various reasons, meaning they don't have more than 4 employees or maybe just all closely held, there'll be some manual claim process. You will need to continually notify the ATO on a monthly basis about the number of eligible employees employed in the business, because, for example, if somebody resigned through that period, you actually have to make sure that they're taken off. And then there's a few little different rules for the self-employed, but generally the answer is do it now to register your interest. They then are going to keep you informed about any changes, and then when registration actually opens. And if it's not a clear-cut case that you actually have had the reduction and it may be a forecasting, or that you will be having the reduction but just not yet, really encourage you to seek our advice about how we could look at your accounts to actually see if we can actually prove that reduction to the ATO if required.
Just on a couple of, I guess, more specific things. We know that an employee can only get the JobKeeper from one employer.
Yep.
So if they've got 2 jobs, they don't get it twice. If employees are stood down, are they able to source work elsewhere and still get the JobKeeper payment from the employer that stood them down?
They most definitely can. That also is available for those employees who may have had their hours reduced. You're definitely allowed to have secondary income. You're also allowed, if you say we're in a sole trader business and you'll claim the JobKeeper payment through a reduction in turnover there's nothing stopping you getting employment or some other source of income some other way, and supplementing that income reduction from the employer that actually was able to claim the JobKeeper payment.
Yeah, and just a follow-on question from that. In respect to an employee that's had their hours reduced, we know that their leave continues to accrue. At what rate does it accrue? At their reduced hours per week or their original hours per week?
No, 100%. We're talking about their normal hours. So not their stood down hours, which would be down to nil, I imagine, and then not the reduced hours. That would be something less than their normal hours.
Just a couple of other quick things. People that are on that are receiving parental leave, and there's been a few questions about that as well.
Yep. So this is a government wage subsidy. So they've put out notice that you can't be in receipt of more than one government wage subsidy. So that is the JobKeeper payment or paid parental leave from the government. And later on when we talk about the supporting apprentices and trainees incentive also includes that as well. You can basically choose one.
Yep. And then, so for the period that they're receiving paid parental leave, that the employee will continue to receive that. If their employer then begins to pay them an amount of parental leave where they're being paid, they'll then be eligible for JobKeeper.
Correct. And also whether or not even they may be then starting to take their annual leave. So if they're engaged and are being paid, like essentially working, because technically like taking leave is classed as like you're working, it would only really be if people were on their own unpaid leave, where that would generally be a break in service.
Yep. Cool. We might try and move on to the next little bit. There's lots of lots of different questions here, but I hope that's given people a brief oversight. We will be releasing some more information after this webinar, just as a summary of some of the things that we've spoken about.
I do just want to make a comment before we finish on JobKeeper, just for people to bear in mind that it is taxable income. It's treated just like normal salary and wages for the purposes of Centrelink income tests or anything else like that. Will go into the employee's tax return when they do it, and as I said, it accounts for income tests, so it is taxable because it is effectively in lieu of wages.
You mentioned the, I guess, some other forms of stimulus that are out there, and that's the supporting the Apprentices and Trainees program.
Yes, so this is actually quite attractive, and it could provide those businesses who are employing apprentices and trainees to sort of get a bit of both, or have the availability to claim a bit of both, not at the same time, but one to the other. So this is a wage subsidy of 50% of the apprentice or trainee's wage for a period of up to 9 months, from January 1 to 30th of September. So the fact that JobKeeper payment didn't come in till the 30th of March, and then that might be a more attractive wage subsidy to get from the government. These employers with the apprentices and trainees will still be eligible for this wage subsidy for the period for January to March, before the JobKeeper payment even came in. It's eligible, so to be eligible, the apprentice or trainee must have been in training with the small business as at 1 March. And it needs to be a small business and defined as employing fewer than 20 employees. It's quite attractive. It's maximum $21,000 per apprentice and trainee or trainee. It's going to be broken up into 3 quarters over the 9 months, which is $7,000 per quarter. And it is paid in arrears. So people who are eligible for that, it actually opened mid last week, so you can actually apply already. You could actually be putting your claim in now for that January to March period, because you're already at the end of the quarter to get your first lot of maximum $7,000. And it's actually going to be open for quite a while too, so there's really no rush. The final claims for payment just must be lodged by the 31st of December 2020, a couple of months even after the scheme's actually finished.
Yeah, and you can't get obviously the apprenticeship subsidy and the JobKeeper for the same employee.
No, it's one or the other, because they're both classed as government wage subsidies. And you need to do the calculations to actually work out what is actually best for you. So clearly we know that the supporting apprentice trainees is going to be a no-brainer for the January to March period, because there wasn't a conflicting alternate wage subsidy. But for looking at it from April through to September, a business really needs to look at the numbers to see what one is actually going to be more beneficial. In both instances, you obviously got to take into account that you are hopefully retaining the apprentice and trainee. So we're going to get some qualified tradies out of this at the end, which is great. But it could mean a difference in actual cash flow to the business if you choose the wrong one. And you can switch at any time. You can switch them back and forth at any time, because clearly your JobKeeper payment has a eligibility of the 30%, so you might be over or under at any point in time, and you can switch between the two.
Yeah. So in terms of, we've basically or briefly gone over what the eligibility criteria is and what, I guess, actions or options are available to employers in respect to their employees regarding the JobKeeper. I guess the next thing is that the registration process, which at the moment is just to register your interest in the scheme. We suspect that over the coming days, that'll become a more formal application process with the ATO. I guess our approach from the office's point of view is that we're looking to sit down with each of our clients just to work out what they're actually entitled to and help them through the registration process, just to make sure that they're not missing out on anything. Payments are then due to start flowing from the first week in May. Just in regards to how that probably there's two payments that are going to start to flow. One is the cash booster payment. The other is the JobKeeper payment. We know the JobKeeper payment is paid in arrears. So for those people that have paid their employees in April, they'll receive that money in May if they're eligible. In relation to the cash booster, that payment process for that is a little bit different. We know there's no registration requirements for that one.
Yeah.
But just want to go over how that's going to be paid.
Sure. Besides actually getting your March BAS right and your future April, May and June BASs or IESs right, which is why I was saying, please let us know to have a look at them before you lodge to make sure you're maximising your benefits. There isn't actually anything you need to do differently to make yourself eligible. The ATO is going to automatically apply any credit that you're entitled to through the activity statement system. So the first period is from either the January to March quarterly BAS or the March monthly BAS. When you lodge that, you may be lodging even in the next couple of weeks. The ATO will not apply your eligible credit until the 28th of April. So if you looked on MyGov or we looked on the portal to actually look at somebody's balance, if they have lodged their return, then we still would not see any credit until the 28th of April. And then the ATO is saying you'll get your refund if you do a refund within 14 days after that. So it is all done through the activity statement system as a credit. It's, as you mentioned in the webinar 2 weeks ago, it's a minimum of $20,000 and a maximum of $100,000 over the 6-month period. And for this initial 3-month period, you try to maximise what will become your first instalment, which effectively is what you'll be classed as what your first 50% of your total eligibility will become. And then for the subsequent 3 months, the ATO will match that first initial payment that you actually got for the remaining 50%. So it's very important that people actually lodge their March BASs because you cannot get this cash boost unless you actually do. But what we've really identified is that there's a bit of planning around a client's circumstances before they actually lodge the March BAS to make sure they're actually not just eligible for the cash flow boost, but that the actual cash might trickle back to the business and not be retained by the ATO. So what I mean by that is that if you've got outstanding taxes, so whether or not they're income tax or integrated client account taxes, the ATO will they will apply any refund that you due from this credit against your current debts. So you actually may not see the cash. The ATO are very accommodating at the moment with regards to looking at putting payment deferrals in place for clients' existing ATO debts where the business has been impacted by this crisis. And if that then means that you've been successful to get a payment deferral, then effectively that means that on the ATO's records, that payment of the overdue tax is no longer overdue. So when the credit gets applied to your account, and if that then pushes that March BAS into a refund position, it means you actually get your refund rather than actually reducing those debts. And they're actually looking at 6 months payment deferrals pretty much at the moment. So that sort of buys you time into September to worry about the older debt and potentially get some much needed cash into the business from the current periods. Now, that's only if you do a refund clearly, because if your overall BAS is still a payable, then lodge it and then ask for another payment deferral on that, if need be.
Thanks, Angela. Look, we might need to leave it there just in relation to those issues. We will get some more correspondence out to clients over the next couple of days or so, just confirming some of the things that we've spoken about and just so that you've got something to refer to. As you can appreciate, these things are still happening pretty quickly. The legislation did only get passed last night. So there's still some questions that need to be answered, and probably what we're finding, it is different for everybody's business. So thanks for that update, Angela. I'll just bring Garry in now, and probably the link to that at the moment is part of the announcement last night didn't necessarily include support for businesses to access this JobKeeper, but provide some sort of funding mechanism in the meantime. So we know that, for the month of April, pretty much businesses need to pay their employees' wages without any support from the government. We thought there might have been an announcement in relation to that last night. Unfortunately, there wasn't. But what I'll call Garry in just to have a bit of chat about what some of the funding mechanisms might be for businesses, not only in the coming month or so, but potentially over the next 6 to 12 months.
Good morning, everyone. Good morning, Mark. Yeah, just in regard to, I suppose a lot of the measures that we've talked about are very much about the government's principal policy about allowing businesses to go into hibernation during the coronavirus crisis. And a lot of the measures that I'm going to talk about are probably consistent with that hibernation policy. I think that's probably something to keep in mind with all the businesses, that if they feel that they're being adversely affected with their business and some of the concessions aren't applying to them, then they're probably people we probably want to hear about so that we can take those issues up with the relevant people. Because sometimes people are slipping through the cracks, and it's clearly the government's intention that for all intents and purposes, they want to ensure that every business that was around a fortnight ago will still be around in 6 months' time. So a lot of these concessions, and particularly the ones I'll be talking about in regard to the SME loan scheme and the mandated landlord agreements, are principally built around making sure that businesses can go into hibernation. So government, just addressing firstly the banks, certainly what the government's encouraging people to do is approach their own bank first, both in regard to the SME loan scheme, but also in regard to any existing loan facilities they have. Just addressing the SME loan scheme, I think when it first was addressed or announced, typical sort of headline policy type issues, and everyone, I think, thought that we were all going to get $250,000 at very low interest rates loans, and as the details filled it out, it's quite evident that it's a loan facility that's built within the existing lending platforms with the banks, but the banks are anticipated or expected to give favourable consideration to anyone to assist them through this hibernation period. Keeping in mind that the SME loan scheme has very narrow policy formats. So, for instance, it's only as a working capital loan. It's only to meet cash flow needs like paying rents, paying staff, etc. What it clearly could be designed to do is to fund the wages during this period of time before people get their payment on the 30th of April. Now, in normal terms, that would probably concern most people, that whether the banks could turn around that policy and application process fast enough to be effective. The indications are that the banks are responding to inquiries, people looking to fund wages very promptly by putting in temporary overdraft type facilities under these SME loan guarantee schemes. So the first thing to do if you're in that position where you've got a cash flow shortage, not sure how you're going to meet the wages for this week, next fortnight, approach your bank immediately to see whether you can have a temporary overdraft facility. It's likely, even if you don't have an existing facility, the bank could be able to put that in place fairly promptly, particularly where you can show that you're looking to use it to fund wage payments and that you will be entitled under the JobKeeper program to have those reimbursed in a short term. Just to cover off on some of the other, I'll go through some of there are some key criteria in regard to the SME loan guarantees. Again, it's worthwhile addressing, and we'll make sure that you get these out in notes. I've done a brief one-page summary of the key issues, which will make sure that people who are attending today get get access to. So firstly, the maximum amount is $250,000. That doesn't mean that everyone's going to get the maximum. The bank's only going to fund the amount the businesses can establish they need to fund their working capital. The loan is for a short term. The maximum term is 3 years. The initial repayments will be suspended for the first 6 months or deferred, and then effectively the loan repayments will be amortized or repaid back over the remaining 2.5 years of the loan. So it's a very short-term loan. Like people might say, well, if I borrow $200,000, I've got to pay it back over 2.5 years. How am I going to fund that? I think the expectation is that you may then renegotiate that loan into a more traditional loan at a later stage. So you may find that you get access to funds initially and then later on decide you need to have an extended period of repayment. So you go out of the SME loan guarantee scheme and you do a more traditional finance arrangement with the bank. Importantly, any loans that are going to be covered by the SME loan guarantee schemes have to be approved by the 30th September 2020. So it's actually a very short time frame. They're not meant to, it's not meant to be in place for a lengthy period of time. It's meant to be in place for that sort of hibernation period to fund working capital. It's clearly not meant for capital asset purchases or to refinance existing loans. The government's made that quite clear. Interest rates are fairly concessional. What we've found is that they're ranging at about 4.5%. You can actually have multiple loans. You can go up to a maximum of 250. You can have a certain amount on an overdraft. You can have a certain amount on a long-term loan, as long as you can show that those loans are being used for working capital purposes. Importantly, you can only access the funding from one bank or institution. You can't go to 5 different institutions to get $20,000 or $30,000 from each of them. You can only go access the money from one bank under the loan guarantee scheme. And it won't allow you to, credit card facilities aren't covered under the loan guarantee scheme. So what they're probably encouraging people to say, instead of having extended credit card facilities, that they probably encourage you to go to a temporary overdraft type facility. Importantly, what was announced, and this is probably governs all the lending that's happening during this hibernation period, is where you get a loan repayment holiday, not only in regard to SME loan guarantee, where you have that first 6 months as a loan repayment holiday, but in regard to any extended arrangement you have with the bank where they may extend your existing loans for a period of where you don't have to make payments for 6 months. Importantly, there's been an announcement by both the government and the Australian Banking Association that it won't affect your credit history or credit rating. And that was a bit of concern on the initially. So that's covering the main things in regard to the SME loan guarantee scheme. It's not, the splash of $250,000 in everyone's bank account. That's been clarified, but certainly it does provide access to businesses to overcome those short-term cash flow positions they might have.
And I guess on that, Garry, for things like paying wages, it's probably ideal, but just because this scheme is in existence, as you alluded to before, doesn't mean that people can't go off and borrow under the more traditional forms of financing where they might be offering up property as security or the like.
Absolutely, and that's probably important point to raise. That those existing loan facilities are obviously clearly still in place, but the banks are also looking at what they can do in regard to those traditional facilities too, in the sense that the normal bank application review process exists for the traditional loans. We're going to borrow some more money. What they're doing though is they're looking at either removing establishment fees or providing significant concessions on establishment fees. They're looking at reducing the interest rates. They're encouraging businesses where the opportunities arise to borrow to continue to fund the growth or the development of their business. What we've probably found, just to give some people some parameters, we're probably seeing that banks are reducing interest rates often 1%, marginally above that, not too much more than 1%. So previously where they might have been charging 5%, they're bringing it back to 4s. They're certainly providing access to loan repayment holidays across the board. Generally that's for a period of 6 months initially. The other thing that people should be aware of in regard to loan repayment holidays, it doesn't mean that actually waiving your loan payments. It just means that those loan repayments will be deferred until a later date. Initially, it seemed that the traditional way that deferral would happen is that you might have a 6-month loan holiday, and then you'd actually have to pick up not only your normal payments, but also those deferred payments in the 6 months following. What we've seen more and more of the banks doing is they're extending that deferred payment generally over either the remaining life of the loan or at least for a period of 24 months afterwards. So they're looking for extended timeframes to recover those deferred payments. There's also a bit of discussion being that's occurred in regard to when you're on a loan holiday, there's potential for loan interest to be capitalised. Well, the loan interest is capitalised, but it could effectively mean that you'll end up paying interest on interest, because the interest gets capitalised on the loan and then you pay interest on that capitalised interest. A lot of banks are actually offering that they're not going to charge interest on the capitalised interest. Now, it actually doesn't amount to a lot of money, but it's actually probably just the principle that they're not going to charge interest on top of interest during that time. So that's something to keep in mind. And certainly the reason I raise these things is, importantly, for your bank, you want to clarify them and have them clarify what the terms of any extended loan banking facilities might be.
Yeah. We're just on that, Gary. We attended a presentation from the NAB earlier on in the week, and there was talk about adding the 6-month loan repayment holiday to the end of the term of the loan, which I think their general view is that they would support that on a case-by-case basis. Interesting to note, what they have said is that according to their sort of statistics and across their customer base, customers are ahead on their home loan repayments anywhere between sort of 13 and 24 months. So those customers who are ahead on their home loan repayments and ask for a holiday won't automatically be entitled to that extension of the loan term at the end. So basically, there's sort of a little bit of give and take there, I guess. Just one other thing quickly, while we're focusing on the bank side of things, directors' guarantees under this SME loan guarantee scheme. Our understanding is that some banks are asking for directors' guarantees.
Yep. So under the scheme, half the loan is effectively guaranteed by the government. So there's been a number of banking regulations that have been changed in order to facilitate the access to the lending. One, the money for the lendings come from the Reserve Bank, and that's why the banks are being able to provide that interest that loan at a low interest rate, even though the loan is could be largely unsecured. What we've found, though, is that it may be unsecured in the sense that it's not secured over particular assets, but what we're seeing increasingly is that the banks are looking to obtain personal guarantees from the directors. So they're not secured over physical assets, but they will be an underlying security from a personal guarantee from the directors themselves. And that seems to be the common scenario, even though the government is effectively guaranteeing 50% of the loan also. Okay.
And I guess that's where, where we're working with clients in the past about appropriate asset protection strategies and trying to reduce the amount of assets in a director's personal name, may be of benefit if something was to happen with those loans.
Yep, absolutely. And probably the other extended part of that is that generally the banks, where they're looking for director guarantees, they will look at the people who are nominated as the directors as opposed to the shareholders of the business. So that may be where having one director who will have the sole guarantor might be a benefit.
Okay, well, we'll move along to probably the second most asked question of the last week, which is around rent. So the whole focus for the government at the moment has been, let's make sure the health system can cope with their impending needs. And that's really where the first lot of funding went. The next lot was, now how do we make sure that people have lost their jobs are going to be looked after? And we've seen JobKeeper, we've seen JobSeeker, we've also seen the business cash flow boost. Probably the last piece in the puzzle in relation to putting businesses into hibernation was some sort of outcome on rent. And what we had an announcement really a couple of weeks ago now that they were looking at some sort of arrangement to cater for commercial rents. And that's been bubbling along in the background. But as of, I think it was Tuesday night, there has now been some further developments on that. Would you like to go into that in a little bit of detail, Garry?
Yes. So the first thing I'd say, if you're a landlord, you definitely want to look at the mandatory code of conduct. If you're a tenant, you definitely want to look at the mandatory code of conduct also. Largely, the code of conduct mainly applies, or does apply largely to those businesses that qualify under the JobKeeper program. So largely those businesses which can justify their turnovers drop by more than 30%, and also meet the revenue threshold of $50 million. So just keep those things in mind. When you read or consider the mandatory code of conduct, you need to consider that it's actually part of the government's hibernation policy, because for landlords, they'll potentially be quite shocked by what the expectations will be in regard to their negotiations with tenants. When I first read the provisions, I thought this substantially changes the negotiating power between the landlords and tenants, and puts the tenants in a significantly stronger position than they probably would have otherwise experienced. And I'd say that we've had a number of, for negotiating or assisting clients, both as tenants and landlords, to negotiate with their tenant or their landlord. And none of the negotiations we've had today would meet the requirements of the mandatory code of conduct. Now, let's not say we did anything wrong. It's simply that there's going to be a significant more negotiation between landlords and tenants. And landlords would probably think, many landlords will probably consider that they've been unfairly treated by the mandatory code of conduct, but they need to give consideration that it's actually part of the government's policy in regard to hibernating businesses. So just to highlight what some of those things are, to give some examples. So there's an expectation that landlords will offer those businesses that qualify the JobKeeper program, they will offer them both a waiver of rent, and a waiver means a discount, and they'll also potentially offer a deferral of rent, and that will be proportionally determined, or determined proportionally based upon the decline in the tenant's business. So to give a couple of different extremes, if the business has effectively been forced to close, say it's a cafe, has no income at all because they can't provide takeaways for a variety of different reasons, then that business will be entitled to, if they're the tenant of that business, would be entitled to get from their landlord a 50% waiver of their rent. So they won't be required to pay 50% of the rent. And they'll also then be entitled to a deferral of the remaining 50% for at least a 6-month period, or for, more importantly, the duration of the JobKeeper program. At the moment, the principle is the JobKeeper program is designed to go for 6 months. But if it goes longer than that 6-month period, then the expectation is the landlord would continue to pass on those rent waivers and deferrals to the tenants. So it's actually very, very significant. The opposite side of that is a business that's turnover only declines by 20%. So they actually don't qualify as part of the JobKeeper program, potentially. And they then have to go hand in hand or hand in glove back to the landlord and negotiate outside of the mandated code of practice. So very significant differences depending whether you meet the JobKeeper program or not. So I think with the focus in regard to JobKeeper has been on largely the payments to employees. But this is a significant impact in regard to commercial tenancies that people need to give consideration to.
Yeah, and I guess we had this conversation last night, Garry, about is it set in stone that they are the rules, or is there some relief for particularly landlords who may not be able to defer their finance commitments and things like that?
Yeah, sure. So there's a range of positions for landlords. So those lands that have got significant debt against the properties, the government's really saying, well, you have the opportunity to approach your bank to get loan deferrals or loan holidays, in which case, the unfortunate thing is it's actually not a loan waiver. So they're effectively waiving rent on one side, but not waiving loan payments on the other side. So the landlords will be disadvantaged as part of that process. So the bank will still anticipate they're going to be repaid their loan. Having said that, there are some other concessions which landlords will be accessed. There's going to be a reduction in land taxes that's worthwhile that landlords will be able to access. There's an expectation that local governments will come to the party in regard to commercial rates, and also that strata levy will be reduced accordingly, but they'll be all subject to the landlord having separate discussions with those parties. They're not mandated arrangements like the mandated arrangements the landlord will be negotiating with the tenant. So largely, there'd be reason that many landlords would feel significantly aggrieved by some of the principles that are in play here. Now, having said all that, there's an underlying safety net for landlords, and that is that if they feel that they're being subject to hardship as a consequence of these provisions, they could go through a mediation process, which at the moment looks like it will be managed by the New South Wales Small Business Commissioner, who currently mediates all the commercial tenancy disputes in New South Wales.
So just sort of, I guess, moving on from that, I guess the change in landscape here is, particularly for smaller business and smaller landlords, the government's actually encouraging people to open their books up and have that discussion. So there's going to need to be some disclosure, certainly on the part of the tenant, in order to access some of these concessions.
Absolutely. I think that increasingly what we are going to find that from our client's point of view, we're potentially going to be required to provide some sort of report which highlights the financial position of the tenant. But also from the landlord's point of view, if the landlord's saying these things are putting undue financial hardship on me, then landlords will probably similarly want some sort of report or statement which highlights that they've been put under undue financial stress as a consequence of the mandated rules or the code of conduct.
Yeah, and look, we've seen different approaches with different clients and different landlords. We've had some landlords offer our clients 3 months waiver just off the bat as a goodwill gesture. But really, what we'd encourage everybody to do is work together with the landlord, working with the tenant to get an outcome that suits both of them. I mean, the important thing here is that if we can maintain as much money flowing around in the economy, everyone's going to be better off. So I think it's important that, when you're going into those negotiations with the landlord, whether you're a tenant or if you're a landlord talking to your tenants, really go in good faith and try and get an outcome that is works for both of you. This is not designed to go on forever. That's probably the other thing, Garry, that these measures are only in place while we're in this pandemic period. It's the first time I've seen that referred to. So apparently we're in this special period, what's called a pandemic. Once that is removed, then everything will revert back to normal.
Yes, yeah. Just one further thing, just that I know that we had some questions in regard to our clients who have got properties in the self-managed superannuation funds, and discussion about whether they could effectively apply these waiver and deferral provisions between related parties. And the ATO have actually confirmed that they would see those matters would be entirely appropriate if you have a company who's the tenant that's owned by shareholders who are also members of the superannuation fund, so they're clearly related entities, and the ATO have confirmed that they would see any arrangements which are consistent with the commercial terms would otherwise be provided in the marketplace at the time would be allowable.
Yeah, that's correct. Probably the only thing that we need to be really careful there is just to make sure that if we are going into those arrangements that we have the appropriate documentation in place, and it still is under commercial terms. So you wouldn't want the super fund waiving a rent for a landlord that's not doesn't qualify for JobKeeper, for example. So it still needs to be done at arm's length. But yeah, that was one of our concerns that we had early on. A number of clients lease their business premises, or their self-managed super funds lease their business premises to their business. So, common sense has prevailed in that sense, and it seems that common sense is seen to be prevailing in a lot of these things. Not all of them, but a lot of them. All right, thanks for that update, Gary. That's probably covered off on certainly the rental thing was the next big piece of information that we were sort of looking to get some guidance of, and now we can, businesses can move forward with some degree of certainty in relation to their cost structures, or at least they've got a starting point. So thanks, Gary. I'll now bring Nick into the conversation. Can you hear me, Nick?
Hi, Mark.
Okay, you've woken up from your sleep.
Can't see me.
No, I still can't see you. Now, we're just going to try and get Nick to share his screen at some point. So hopefully that will work. Otherwise, his presentation will be difficult. Probably, Nick, and this is flowing on to, what do we need to do from a cost point of view, particularly, and a cash flow forecasting. Businesses now have some certainty over JobKeeper and how that money is going to support their business. They now have some certainty around, or some guidelines around what a rent arrangement might look going forward. So yes, you've been spending a lot of time working over the last few weeks in relation to preparing cash flows and looking at how businesses can survive the next 6 months.
Yeah, absolutely. And look, as you said, we've been spending huge amounts of time preparing cash flow forecasts for clients, really to just be able to give certainty about what their future cash runway looks like, depending on the level of impact that this pandemic has on their business. And I guess, the vast majority of businesses are impacted in some way, whether they are losing a small amount of revenue or their entire business has been shut down. And really what a lot of the discussions we're having with clients come down to, how do we make sure that our existing cash flow is able to last us and our business through this period of time. And in a lot of cases, ultimately it comes down to cost restructuring and looking at the areas that we want to try and attack first. So you can see there on the slides, utility providers, suppliers and overheads. With utility providers, so electricity companies and things like that, they've already come out and said that they're quite open to negotiating payment terms, providing waivers of payments in certain circumstances. And so, especially where businesses have been significantly impacted by COVID-19. So encouraging all of our clients to be really jumping on the phone and having those conversations as early as possible if they think that they qualify. The next part's your suppliers and your other overheads. Now, a lot of the suppliers of our clients are also going to be small businesses. So they're going to be feeling the pinch as well. And I think the message we've been sending to clients is that everybody's feeling pain right now, but we still want to make sure that cash flow is moving through the economy. So our suppliers who are operating their small businesses, it's important that where we can, we're still making payments to them. What we then want to do though is say, well, what are the other areas that we can really carve back our cost structures? And that then leads into things like bank loan payment deferrals, ATO payment deferrals and those sorts of things, so that we're able to keep cash reserves to, I guess, allow our business to survive through this period, but make sure that it's getting to the parts of the economy that we need it to be able to get to as well.
Yeah, and I guess that's, if we go back to our very first webinar, the focus was building this war chest of cash, and clearly that goes against what we're now saying is that, yeah, we need to send a little bit of that money floating around to our suppliers to make sure that we can all keep operating and using a bit of common sense there. I think what's happened also in the last week or so, people are a little bit more comfortable about what the new normal is. We haven't had any changes to the lockdown rules and that for a week or so now. So people are becoming a little bit more comfortable with the environment that they're operating in. And that gives them a little bit more confidence to start making some of those decisions.
Yeah, exactly right. There's less panic at the moment than there was 2 weeks ago as a result, but there's also more certainty around the various government stimulus measures, which means that when we're preparing cash flow forecasts for clients and we're stress testing their businesses, all of a sudden they can see how they're actually going to make it through this period of time. And once you can see how you make it through this pandemic, it makes you a lot more comfortable, which means you then start to spend money again. And the concept of building a war chest is still really important. It's just about what sources of capital we choose to build that war chest. And I guess what I'm saying is I'd rather clients be using the ATO and bank deferral holidays than not paying small business at this point in time.
Yeah. Probably just, and this is coming from a question, is have you seen, any movements over the last few weeks about pressure that can be applied to sort of larger organisations that typically might have 60 or 90-day payment terms about lobbying for them to bring those forward? How would you approach that?
Yeah, look, I think you need to do everything you can at this point in time to get paid as soon as possible, especially from larger corporations who may not have had the same impact to their revenue and their bottom line as small business has. Ultimately, it comes down to having open, transparent conversations with your business partners, whoever that may be. If you do, it may come down to things like asking for discounts for early payment, or alternatively, providing discounts if they can pay you inside their normal payment terms. We know that the credit terms for some of the larger corporations are dictated by them, as we don't have a lot of control. But jumping on the phone and explaining the position you're in and the need for it is often the best way to go about it.
Yeah, and I think it might have been the Victorian state government brought their payment terms back from 30 days to 15 days right at the start. Don't quote me on that, but I think there was some announcement by, it certainly was one of the state governments, that they would not delay the payments, or they bring forward the payments at the start.
Definitely was, yeah. Again, not sure which government it was now. There's been so much information over the last few weeks, but they were very, very fast to come out and be on the front foot saying we're going to shorten our payment terms. And I guess the message to business owners is we really need to treat it as nothing being off the table right now. Certain things that you thought you'd never be able to ask for in the past from your business partners, by all means, if it becomes critical to your business, ask the question.
Yeah. I guess that, the next thing for businesses, these new revenue streams. And it's funny, last night I was looking for something to watch on TV of the sporting variety and stumbled across the V8 supercars were doing a e-race last night. So all the teams participated, all the drivers participated. You actually had to look twice to realise that they were actually not racing their cars, they were racing on a computer. And I know that Formula One have done the same thing. So there are a number of in this case, sports that have looked at rejigging their product So they've still got something to sell in a time when their business can't operate normally. You've seen businesses doing that as well?
There are. The really clever business owners have been very fast to look at their strategy to ride out this period. They probably recognise that they may not be able to generate the same revenue, but they're not going to sit idly by and accept no revenue. So what can we do within our business to take it online? Now, the typical one people think about is retailers going online, but what about if you're providing some other level of service or training where you can all of a sudden adapt that to online training course? Your core products may no longer be in demand, but there are other products that are in huge demand at the moment. So how can we adapt our equipment and our people and our business to be able to sell, those products at the moment? Retooling. We've got a client in the 3D printing space at the moment. They've adapted their business to be making protective shields for New South Wales Health, completely away from what their normal business was, but really clever strategy.
Yeah, and certainly a number of our clients in the medical and allied health professions have moved to telehealth and have done that pretty quickly. So it's effectively delivering the same service to their clients, but in a slightly different way, or a vastly different way in some circumstances.
Yeah, absolutely.
So if I'll just see if you are able to share your screen, Nick, and we can have a look at the stress testing side of the business. Just while I'm doing that, Angela, if you're still there, I might bring you back in for a second. Because I can't see you. One thing that we did skip over, and we have had a question about it, is the assistance from the New South Wales government, the grant funding from the New South Wales government.
Yes. So this is a recent announcement that came out on the 3rd of April. It is for New South Wales. So there's a new assistance scheme involving grants of up to $10,000 New South Wales small businesses, and they're particularly for those businesses that have been impacted by the shutdown provisions imposed on them through no fault of their own. The government has put a fair bit of money behind this. The eligibility is that the small business needs to have less than 20 employees and a turnover of more than $75,000. So $75,000 is generally the threshold where you must register for GST. So you'd think that all these businesses then would be lodging BASs and the like. Another eligibility criteria is that the business has a payroll tax threshold of less than $900,000. So smaller businesses. They must have an ABN on the 1st of March, be based in New South Wales and employ staff as at 1st of March. Those dates sort of line up with those other wage subsidies as well. They need to be highly impacted. I thought I read somewhere that there was a percentage put on that, but I couldn't locate it, and everything that I've found now still just talks about highly impacted by the public health order issued on the 30th of March. The listed industries that they define as highly impacted are those that have been subject to closure or highly impacted for the closures is retail trade, accommodation and food services, rental, hiring and real estate agent services, administration and support services, and arts and recreation services. Now, they didn't say that that's exhaustive. They just listed those in their initial information. And they must use the funding for unavoidable business costs such as utilities, overheads, legal costs, financial advice. You would generally think that even if you're able to come to some arrangement with some of your suppliers and negotiate either reductions or anything like that, you're generally going to have in this 6-month period overheads still of at least $10,000 for this to cover. And you'll require to provide appropriate documentation upon application. What that is, don't know yet, but that just says that. And then the applications for this grant will be available through Service New South Wales themselves within a fortnight, so not quite open just yet, a couple of weeks away. And they'll remain open till the 1st of June 2020. So again, not something you've got to rush out and do, but something that you can consider your eligibility and then apply.
Okay, thanks for that, Angela. Just so you're all aware, I'm going to see if I can turn your video on now, just so, see if you can, there we go. So just say hello to everyone so they can...
Sitting in the dark all day.
Okay.
So, there we go. So I apologise for those people that are on the call that we had an issue with the video, but everyone's back and up and running now, so that's good. So Nick, do you want to go through this? Nick's been working with some software called Float, which helps project cash flow. So if you want to share your screen and just go through that quickly. I understand we've gone way over time at the moment, but we'll keep going. There'll be a recording available for those that need to jump off the webinar, but probably spend 5 minutes with Nick just running through some of the modelling things. Here we go.
Okay.
Yep.
Very
cool.
good. So look, I'll just run through this quickly, but it's really just about highlighting the need for cash flow forecasting and the benefits that it can provide when we're living in a time of huge uncertainty. So I guess I'm always looking at new technology, but really what this Float software has allowed us to do is to create cash flow forecasts for clients. And in this scenario, it's some demo data. But to be able to create a base scenario based on how their business would otherwise be operating, or alternatively that they've already shut down, what their existing overhead structures are, so they can see what is likely to happen to their cash balance over the next period of time. And predominantly at the moment, I'm really looking up until around the end of October. That sort of 6-month window that one, the government is talking about, but two, it's the period of time that all of the stimulus measures are in place for as well. So what we can then do is create a number of scenarios to stress test the business and make certain decisions regarding costs or outgoings at different points in time. And as you can see, for this purpose, I've created 3 alternative scenarios where there might be a 25% revenue drop, 50% revenue drop, or a 100% revenue drop in a business. Now, at a 25% revenue drop, a business may not qualify for the JobKeeper package, but it might qualify for the cash boost stimulus from the government. So you can start to have a look and model one scenario over the other and understand what impact all this is going to have on your cash flow. Now, if this line is going to dip below 0, it starts to show it in pink, basically saying you're running out of money at this point in time. And you're then able to say, well, if I'm going to run out of money at the end of July, what do I need to do now to make sure that that doesn't happen and that my cash runway or my cash reserves can last until the end of October or as long as possible. Now, in this scenario, under a 50% revenue drop, what you can see is that the green line actually dips above the blue line for a period of time. Now, what's happening there is the business is qualifying for a lot of the government stimulus, it's qualifying for JobKeeper, but they've also been able to put certain outgoings on hold, such as ATO payments, rent arrangements under the new Code of Conduct, or potentially other loan repayments as well. And what we can see as a result is the business is actually able to hoard its cash or create its war chest through, I guess, the period of uncertainty. Then once we get to October, when government stimulus starts to run out, some of the deferrals of payments become due and we need to start paying those things back, we can see the significant impact that it will have on cash flow. What that tells us though is that in a lot of cases, we can model the numbers so that businesses can understand how they survive through this period of time. And there's I guess, there's little doubt of it, that if this pandemic runs longer than the 6 months, or as we get closer to October when a lot of the stimulus measures run out, if we are still right in the depths of it, the government, I'd like to think, will be offering some further support to businesses, because what we can see is the gravity of the fall away in cash. Now, what we can then do if there is a business that has 100% drop in revenue is the stimulus measures are not enough. Deferring ATO payments are not enough. What it allows us to see is how quickly these businesses go backwards. And this example starts from a pretty low opening bank balance anyway. But it allows the business owners right from the outset to say, okay, which suppliers do I need to talk to? Which other overheads do I need to start cutting right from the outset? What new products or new revenue streams do I really need to focus hard now to try and bring into the business so that I can make sure that my cash flow lasts as long as possible? In plenty of cases, well, certainly in a few looked at over the last week, we've had businesses that have basically lost 100% of their revenue. And by taking those hard decisions now and creating an action plan of who needs to talk to which suppliers or which business partners, we're actually able to see how those businesses can survive with their existing cash reserves and support their staff through things like JobKeeper between now and the end of October.
Yeah, look, it's and really there's a lot of obviously detail that goes into creating those forecasts, but really what we're looking for in a visual sense is, yeah, what's our point of no return, and you know, how long can we keep doing what we're doing before we need to make a change? And that's the beauty of using this software to do it is it's quite clearly for clients spells that picture out in graphical format as opposed to numbers on a page.
Yeah, that's right. And look, it's a really good tool because it allows us to portray the numbers in the most easily understandable way to clients. We can look at numbers on a page all day, but not everybody can. But it's got the structure there for us already, so that we're not recreating the wheel, and we can, whilst there's a lot of detail that goes into it, we can turn it around relatively promptly for clients at a point when they need this critical information.
Yeah, and Gary's just probably added a comment there as well to say that could be one of the tools that businesses can go to their landlords with to say, look, this is what I've projected, this is why I need some help, and you know, to support what's happening in their business.
Absolutely, I think that's a great point.
Okay, well, we might leave it there, Nick. I think just probably one closing comment in relation to that is, yeah, the stimulus measures or this pandemic period seems like it's going for 6 months. That's where all the costing from the ATO and the like is happening. But we know that's not going to be the end of it. It's not going to be that, you know, come September or October, if businesses are able to move around again, that their revenues are going to jump straight back up to where they were sort of in January and February. It is actually going to be a slow road up in building that revenue back. So clearly these forecasts have shown a 100% revenue drop indefinitely. But it might be that, you know, in some of these things, we start to model the increase back up on the other side, whenever that might be.
Yeah, exactly right. There could be 100 different scenarios we could project for any business, but coming out the other side will be that next critical piece that we need to look at.
Yeah. Okay. Thanks for that, Nick. Just going to go back to my screen. There we go. So I hope they're probably the main things that we wanted to cover off on today. I hope that it was both informative and that everyone's taken something away from today's presentation. We've tried to answer as many of the questions that you've sort of typed in as we've gone along. No doubt there'll be more questions. which please feel free to forward them on, and we'll sort of address them over the coming days or weeks. There's pictures of us pre-coronavirus, all looking pretty good. But probably what I wanted to, I guess, finish up on is what do we need to happen from here? So I think that the first item there that we need to have a look at is to, we need to determine our eligibility for stimulus and start the application processes. So that's something that we'll be working with clients over the next 2 weeks. You can probably appreciate it's going to be a pretty intensive period of work for us over the next coming weeks. So we are getting to everyone as soon as we can. So please, if you can be a little bit patient, we'll make sure that everyone's looked after. But it is also a little bit, we're not working under normal conditions at the moment either. Our staff are working remotely, which has been working really well. And we've been really impressed by their commitment to our business and also, more importantly, to the clients. But it isn't the same as being in the office, but we're doing the best we can. So that'll happen over the next 2 weeks or so. We would advise to look at your cash flow forecast for the next 12 months. As Nick pointed out, it gives some good insight as to when or if you're forecast to run out of money, but more importantly, what a recovery might look like, because we know a recovery is not going to be instantaneous return to where we were. So that's important. Point that Angela touched on, we need to put arrangements in place for any ATO debt, current debt that we've got outstanding, just to make sure that we're getting the stimulus money applied against the right debts with the ATO. So that's important, and that's probably important for the up until the 30th of April, when that stimulus money starts to find its way out. Commence discussions with your landlord. If you're a landlord, commence discussions with your tenant. This has probably been the missing piece of the puzzle at the moment. Whether you go through your agent as a starting point, whether you have initial discussion directly with the landlord, but there's enough guidance out there now to start having those conversations about how we approach rent in terms of in a period of hibernation. As Garry pointed out, talk to your bank manager. Lots of clients have done that. The banks, from what we've seen, have been fairly responsive, which has been good. In relation to repayment holidays and funding requirements, particularly if there's options there to fund wages over the next month or so, in light that the JobKeeper payment won't come in for another month or so and will be paid a month in arrears. Could be that overdraft's an option there. It could be part of the government's loan guarantee scheme. But more importantly, enjoy the Easter break. It's been a crazy 3 weeks for everybody. We haven't seen this before. What I would encourage, we're encouraging our staff to do, and ourselves, is to make sure you do have some downtime over the Easter break. This thing's not going to go away. It will be there next week, but it is important that you take some time out to spend with your family, take some time out for yourself, recharge the batteries, and then attack next week and the coming weeks, with a clear mind and energized. So I think that's really important. So we'll end it there. I'd like to thank everybody for joining again. I think we had over 50 participants today, so that's a new record for us. We'll look to certainly put on some more webinars as we need to, and in relation to topics that come up over the coming months. So again, thank you, everybody. I hope you do have a good break over the Easter period, albeit staying at home. Please be social, be responsible. The sooner we can all get out and about again, the better. But, if that means we have to stay at home this Easter, well, so be it. It might mean that we'll get out sooner. So thanks again, everyone, and we'll talk to you next time.